Oil has been edging lower today on the news of Angola's departure from OPEC. There are other factors to consider when it comes to oil as well, from surging U.S. production to the disruption to shipping in the Red Sea. For perspective on all of it and his outlook for oil prices in 2024, we're joined by Rory Johnston, founder of Commodity Context. Rory, thanks so much for jumping on with us.
Thanks for having me.
So this news that Angola is leaving OPEC due to a dispute over the reduction in output limits, just how significant do you think that this departure is, and then the possibility of what it could mean, in terms of the production side of things? If Angola felt limited, is it going to be trying to pump out oil at this point?
Yeah, so I think there's good news and bad news here, depending on which side of this debate you're on. I think the good news for oil bulls is that Angola, if it is freed of all of its OPEC quota obligations, there's a reason it's been producing under its quota for the past 3 years. It can't produce that much. So even without, unshackled from OPEC controls, it's not like production is going to grow by any meaningful amount. Now, technically, next year we would have been expecting a mild cut from Angola if it was to follow through with its OPEC quota. But again, we're not talking major volumes here. And I think fundamentally, it's actually mostly a neutral or negligible effect on the market. That said, I think where it does become more bearish is what it says about the broader political stability within OPEC and OPEC plus more broadly. Obviously, this organization now is withholding 4 or 5 million barrels a day, depending on how you count it, from the market. They're, contributing substantial, supply support and market support. If you began to see cracks emerge that could be kind of widened and you could see, further damage to cohesion, I think that's the worry here. And we've known that, OPEC plus and Angola and Nigeria in particular have had issues with the revised quotas and baselines. But I think now this is just, this is the final straw and they're out. And I think, the optimistic rub here is that the remainder of OPEC is actually much more cohesive and aligned around production policy, but they're now one member down.
Okay, so there isn't another member that jumps to mind where you think, oh, they might be disgruntled enough to walk away as well, who might actually be impacted by the limits that are being imposed on them or that they've agreed to, and who could have potential here to add to the market?
If we're looking for a country like that, the only one that springs to mind, and by a long shot, is the United Arab Emirates. The UAE right now, its baseline, it's the only member that's actually been managed to argue for an increase in its baseline next year. So while the rest of OPEC's actually cutting next year, the UAE will actually be incrementally increasing production to reflect this new baseline. And the reason it's been able to kind of secure this baseline revision higher is that OPEC's current baseline is a full 1 million barrels a day below their technical production capacity. So if OPEC was to explode tomorrow, you'd obviously get a huge amount more oil from Saudi Arabia, Iraq, et cetera. But most notably, you would get a huge amount more oil from the UAE. So I think they've been kind of spoilers in previous negotiations. But I think if you're watching for weakness or a sign that things would really impact the market, I think you have to look at the Emiratis.
We've been following the attacks in the Red Sea to ships that are trying to make their way through that area. As a result, we've seen a lot of shippers not wanting to take that route. In fact, the Bloomberg most recent data shows that about 30 tankers, including crude oil and fuel carriers, have made their way through that area so far this week, and that's down about 40% from your average week. So there's still some transportation happening there, but there's been quite a decrease. How significant is that to energy markets, potentially to prices, Rory?
So it's a very substantial shock, and particularly a headline shock to market. And I think absolutely is part of the reason we're, $7 a barrel higher, week over week right now, or relative to the low point of last week. And that's just, again, we've been so overstretched negative. Positioning has been so bearish that really anything should have sparked a rally. And I think, actually disrupting tanker traffic through the Red Sea region and through the Suez obviously is a major factor. It's 10% of the world's shipping. This is a huge deal. But I think the impacts are inherently capped because you're not actually losing any functional supply from the market. So let's say, for instance, round numbers, 10% of global oil went through the region and all of it got displaced to now go the much longer traditional route around the Cape of Good Hope in the southern tip of Africa. That's a 40% longer journey. It's, instead of 26 days between Rotterdam and Singapore, it's 36 days. So let's say 10 days extra. That basically would manifest as a supply shock for 10 days. But then you would reconnect that longer, pipeline on water, if you will. Mm-hmm. And the other aspect here, so it would temporarily contract markets, but theoretically, presumably this disruption also isn't permanent. So when this disruption eventually, yields and security improves in the region and tankers end up going back, then that pipeline and the elongated pipeline actually then dumps back. So you actually get a supply boost on the other end. So I think it's a temporary supply shock, but inherently temporary.
Yeah, something to continue to watch. But as we're heading into the new year, Rory, are there, particular forces that you'll be watching out for that you think could be particularly influential in 2024?
I think there's two things that the market is watching entirely, and it's going to be how much does demand grow next year? Because again, there's still all these questions about what is the normal pace of global demand growth coming out of COVID? So if we get, 1.5 to 2 million barrels a day of demand, that's, I think, what we're going to need for a tighter market. Anything lower, and I think the rest of non-OPEC supply has an easy job keeping up with it. The other aspect of this is obviously U.S. supply, which has surprised virtually everyone to the upside this year. Most of the agencies versus a growth this year of 1.5 million barrels a day, a lot of them see that falling back to 600,000 or 700,000 barrels a day next year, or having from current, more than having from current growth. That is a pattern that we've seen repeated time and time again. And I think U.S. supply has historically surprised the upside. I think that's the big thing to watch. And if those things don't go a bullish direction, don't tighten markets, the final remaining big question is, how does OPEC begin to ease the supply back into the market? Because, absent a broader ex-OPEC deficit emerging, there's no real opportunity for them to do it without having a major negative effect on prices.